We do have an issue today. We are red, and it's largely because yields are back up, oil's back up, threats are back up from the White House and the president regarding Iran. Markets obviously don't love that. Still, as I said in the open, many big investors say the environment's bullish. BlackRock's Rieder, he told me on closing bell we could get another 5 to 10% out of this market this year, and that there's so much going on, it is almost overwhelming.
I will say, Scott, this is the best, most exciting, most fun investment environment. And then I go home at night and and I fall asleep immediately. It is exhausting.
Wow.
It is. There's so many. I mean, like today alone, like you said at the open, the cross currents. We spent a bunch of time today on healthcare. This Moderna news is significant. So we started looking at the tools businesses. We looked at different parts of healthcare. Like, boy, every day there's a new menu to look at. I will say one thing. I've never in my career felt like every day I come in and I feel like I'm prepared, and I go home and I feel like I'm behind. And it's incredibly exciting time, but it's stressful because we're learning so much every day.
Well, we thought that was a great jumping off point for us today to have a really robust discussion. We'll start it off with you, Josh. When you hear that from the gentleman at the world's largest asset manager, who is the CIO of not only global fixed income, but heads their global allocation team. He's as plugged into the bond market and the stock market as you'll find anywhere on Wall Street, and that's what he had to say. Rick Rieder, what do you think?
Exciting's not always great, I guess I totally agree with everything you said. Especially in fixed income. I don't think most people are allocating the fixed income portion of their portfolio hoping for excitement. I think you guys would probably agree. I think we get enough excitement from the equity side. But to his point, longer yields are back up today. So we did a little bit of jawboning exercise, a little messaging, let's call it, from the Treasury. Yesterday, now we're back up 6 basis points, which is the biggest mover of all durations. The big picture here is this is not Trump specific or Bessent specific or U.S. Fed specific. What we're seeing at the long end of the bond market is happening literally all over the world, everywhere except for Switzerland. Why not Switzerland? Very disciplined with their debt. Everybody else, it's been a free-for-all, especially since COVID accelerated what's been going on for 15 years. No political party in any developed country around the world wants to make any tough decisions. And so in the absence of any kind of fiscal discipline, what we essentially have is deficits growing. Now you couple that with political dysfunction, and you see this happening in the Japanese bond market. You see it happening here. It's happening in France, the UK. This is a global phenomenon. And I don't mean to scare people, because the good news is, yes, we are now approaching 1-to-1 on debt to the size of the economy. It's a little bit scary. However, who owns the debt? In the case of the United States, we're paying interest to ourselves. Investors own most of the debt. And so long as that equilibrium is in place, we can keep kicking the can. We can do this into another administration and then maybe even another one after that. So the stock market has been able to hold in. The excitement that Rieder is talking about, absolutely, that's going on the bond side of people's portfolios. But I don't think
he's talking about on the stock side, too. Let's not just judge him by his title. He's not talking about, oh, there's so much excitement on the credit side. Forget about what's happening on the stock side. He's using the Moderna Merck news yesterday to say, this environment is incredible. Look at what's happening in AI. Look at what's happening in healthcare. Look at what the beneficiaries are going to be in XYZ areas. And it's so hard to keep up that it's almost overwhelming.
And who could disagree? Right.
Yeah, I mean, what do you think?
I mean, there's no question that there is so much going on right now. There's genuine enthusiasm. There is enthusiasm because of the GDP trajectory. There's enthusiasm because of the earnings trajectory. One of the challenges that we see is in the very short run, it's gotten a little lopsided with sentiment. It's definitely
people are too bullish.
Yeah, there's definitely a start. We're entering a seasonally weak stretch. Mid-October, mid-August through mid-October are historically seasonally choppy, maybe not weak periods in the market. And ultimately, though, I think if we do get some type of re-rating on this scare, that you have to be a buyer of this. I would also say
what scare? The backup in yield?
Yeah, the backup in yield, which I think's you're fighting policy, the White House, the Fed, Treasury, maybe the Fed. We'll see next week. But the reality of it is that has been the worst bet to make in markets since the new administration took place. Is every time there's an issue, making a bet against that, extrapolating. Look at what happened when Yellen did this, Scott. She, again, did the Operation Twist, right? Issued short end to buy long end, and yields fell 100 basis points over the following 12 months. I'm not saying you're going to see that because I think we're entering a systematically higher yield environment, but it's well supported by what's happening economically. And that's what Rick is citing. And by the way, earnings are not just terrific.
Rick is not suggesting that the economy's booming. In fact, it's the alternative. It's good, but it's not great. And then if I layer on to you that maybe the biggest reason that yields have backed up is because, and I don't even know if it's a maybe, because I think people are in agreement, and even the Treasury Secretary himself said it on the air this morning, the amount of issuance that you have had enter the market because of the AI build out is having, he used the word asymmetric in terms of the kind of information that he thinks he has versus what the markets have. But it has had, some say, an asymmetric impact on the move in yields, maybe more so than anything else.
Well, it's also had an impact on equity valuations as well. We entered at 23.5 times, and we're at 19 times right now. So,
well, thank you, earnings.
Well, of course, but you could have maintained that pace of play and could be up even more just because earnings have been so powerful. I get your point, but there's another point in that we've had some multiple compression, and some of that is due to rates. You can't ignore that. It's not just due to pure earnings power.
No, but you're suggesting that, and he said, the Treasury Secretary did, of course, we can do more if we have to, we want to. But the point is, just like the Fed, by moving interest rates, can't really deal with oil-induced inflation or tariff-induced inflation, can the Treasury really do anything by intervening in a market that is being asymmetrically driven by the tremendous amount of issuance that's coming on the market related to AI? I think it's a fair conversation to have, fair question to ask.
Totally a fair question to ask, but I think when you get yields at these levels and you see the issuance, yes, you've got a hyperscaler issuing at 10 to 15 basis points more expensive. Big deal when you have that type of growth coming out of this area. I do not care. Honestly, I do.
No, I know you don't care, but the long end of the Treasury market
cares. The long end is caring until there's clarity, more clarity around how they're going to do it. And the first shot across the bow was yesterday that we want to control long-term rates because that's prudent. We don't want it to become unhinged.
I thought you were talking about more clarity from the Fed. Because even President Muslim, who was just here, said, you can still not give forward guidance if you don't want to. I don't think, most people at this point are not great fans of forward guidance, but that doesn't mean you give no idea of what your framework is to get to the target that you suggest that you darn right will get to. You need to communicate that to some level.
And I agree with you, and we might have forced that communication, and that's why, Jackson Hole becomes so important. But I can tell you from a portfolio standpoint, when I hear the amount of banter on how fearful people are about higher rates right now, you know what it makes me want to do? Buy duration. Always works. Maybe not today. Maybe we get a little more extended.
How much duration?
But
how much? The 10-year, not the 30-year.
Yeah, I mean,
okay. I was going to say.
Yeah, no, but
here's the portfolio benefit. One more thing, yeah. Josh, you know this.
I'll buy a 5%. I'll buy a 5% 10-year.
Exactly.
So for the first time in a long time, fixed income now can actually hedge if we become unhinged because there will be demand for that price.
So I agree. And to your point, there are like no iron laws in finance. Almost nothing really works all the time, every time. The closest we have to an iron law in investing, asset allocation, is that the starting yield on a treasury, if you hold for that period of time,
is what you
and then you dial back and say, what was my return, my total return, very important, not just the yield. The starting yield is almost perfect so hypothetically, if they get the 10-year up to 5%, and everyone on the network's freaking out, and clients are calling, what do we do? What does it mean? If you buy that 10-year and you take that 5%, print, and you hold it for 10 years, you're going to get 5%. Like within 95% range of probability. You can't say that about anything else you can do in a portfolio. You can't say it about PE ratios. You can't say it about really anything. But if that's where they're going to take the 10-year, I'm going to go to 5. I'm a buyer too. I think Rob's exactly right.
Josh, I'm so glad you brought in asset allocation because the three of us do that for our clients. And we all know that if we went back 5 years ago, it wasn't 4.7%. It was like 1.5%. And what we were telling our clients was put these bonds in because it will stabilize your overall portfolio.
And that's all you're getting.
And that's all you're getting.
Right.
We actually, I'll speak for you guys. We actually like this because we can give volatility dampening in our clients' portfolio through bonds while still giving them a real after inflation return. Now, of course, this means that somebody who is buying a 4.7% treasury or a 5% 10-year or 5-year corporate bond might be taking that money from equities. But to Rob's point, we have a strong economy. We've got good profit growth, and people who are thinking about selling their equities in order to go into fixed income are considering, do I really want to give up on this market? I don't think
that's where the debate, people aren't thinking about selling their equities and going into fixed income. I think if there's $9 trillion in money markets sitting out there, people are wondering, should I take the cash and what asset class should I put that to work in? And it's not necessarily, there's been articles written lately about fixed incomes being as a hard, if not impossible sell by what you guys are trying to do for your clients. There's no interest.
That's because of the last 10 years.
It depends on Look, it depends on each individual and their risk tolerance. I happen to be an equity portfolio manager at heart, so given the choice between, let's say, a 5% 10-year bond and the equity markets right now at 2019 times earnings, which is a corresponding 5% earnings yield, I'll take equities all day long. Not because those numbers are equal, but because I've got that growth rate in earnings that I feel very confident about seeing the earnings reports coming in.